Alright, so you might as well call me Walmart, because I'm always on the hunt to find great value in the stock market. Hidden gems, undervalued stocks, dividend compounders that are under the radar of most people. Of course, in a perfect world, I would double down on the ones that are already in my portfolio or on my watch list, but sometimes they go back up in valuation and their prices are fair, and I don't want to buy into it when they're fair. I like to buy into stocks when they're on a discount or with a 10 or 20 or 30% margin of safety baked in. And I think I found a potential hidden gem. But to make sure, we're going to put it to the test. So today in this video, we're going to talk about the most boring monopoly that you've never noticed before. And it's a sleepy stock that's behind every baby shower, at least it is here in the US and in Canada. The name of this company is Carter's. Ticker symbol CRI. What you see on your screen right now is obviously the Seahawks and Tottenham flags, but also the flow of the video. We're going to be reviewing the company's story, their financials and fundamentals to really see if it's a dividend compounder or not. And if you stick around until the end, I'm going to be giving you what my personal game plan is going to be, and also some encouraging words for you. Alright friends and family, let's talk about Carter's business overview, how they make money and what's their biggest growth driver going forward. So Carter's is the biggest clothes maker for children in North America. Their brands include Carter's, Oshkosh B'gosh, which is really funny because I actually made a deep dive video for Oshkosh, the industrial machinery company. But anyways, their other labels include Skip Hop and even Little Planet. They just started up a sustainable line where it's all like 100% organic cotton. But it's not just these baby clothes that they sell at their stores. They also make the store brand baby clothes for Walmart, Target, and Amazon. So even if you buy from the competition, it really doesn't matter who you buy the baby clothes from, because Carter's is still the winner since they're the ones getting paid for those clothes. Case in point, in Walmart, their in-store private label baby clothes brand is known as Child of Mine. Guess who makes it? Carter's. For Amazon, it's called Simply Joys. Yeah, that's made by Carter's. When we think about Target, Just One. Yes, that's also made by Carter's. And their customer base, when you think about it, it basically refreshes every single year as couples become new parents. So there's a new family that becomes a customer of Carter's every single year. There's an endless supply of potential leads in order to replace the customers whose children just get too old for Carter's. I think by the time you turn like 6 or 7 years old, you probably stop wearing Carter's. But the good news is there's always going to be a newborn baby to take their spot. And their biggest growth driver going forward is their push right now into international markets. I think they're currently in 90 countries where the birth rates are a lot higher than the US. But speaking of which, because the US is their core customer, let's go ahead and take a look at the landscape of babies being born here in the land of freedom. So what you see on your screen right now is the birth rates in the US from 1985 all the way to what it is today of 2025. And this number right here is the number of live births occurring during that year per 1,000 people. So when you think about it, it's shrinking year over year. And right now it's 11.99 per 1,000 people that live here in the US. So it's going from about 15 kids being born per 1,000 people to roughly 12. Folks, that's not really good for the business model for Carter's. Okay, but now that we know that Carter's basically makes and manufactures the clothes for their competition, then who exactly are their rivals and peers? Well, what you see on your screen right now are the clothing companies that they describe in their own 10K as the competition. And next up, let's go ahead and talk about the arguments against Carter's. Number one is going to be the slow growth. So Carter's has been around for a really long time, and their growth is just non-existent. We're going to talk more about this a little later. However, they posted $2.9 billion of revenue in 2014. And as of today, it's pretty much the same. And then number 2 is the birth rate. And as we just learned of the shrinking birth rates in the US, that's not good. Slower population growth means a slower revenue growth for them ultimately. And then number 3, competition. They might not think of it, but I think the fast fashion companies based out of China are going to eventually steal customers. I'm talking about Shein, H&M, Temu, and all of those Chinese companies because they can make the clothes at a cheaper price point for the customers. Now, enough with the negatives. And let's think about and talk about the positives for Carter's and if they have an economic moat or not. Number 1, they are the market leaders in the baby clothing industry. Their market share makes them the biggest dog at the dog park. They're basically the pit bull who's not neutered with big balls swishing back and forth. They're the biggest dog in this fight. And what I mean by that is Carter's has a 28% market share for newborn babies and a 10% market share for all other children. And I think that's because their brand and image is pretty respectable among the mom crowd. Which means when one of their friends have a baby shower, they're most likely going to get them the clothes that worked well for their kids, and it just spreads like a contagious, infectious disease. Everybody will want Carter's. If my best friend has Carter's, then I want Carter's. If my neighbor has a BMW, then I want a Tesla, and so forth. And then number 2 is that, quote unquote, their competition actually allies. Right? Their brand portfolio goes beyond just their own label and the Carter's stores. They make the exclusive clothes for their competitors. So are they actually competitors in the end? No. And then number 3 is their financial health. Believe it or not, with pretty good cash flow for the time being. And we'll talk more about this when we get to the numbers section of the video. And in regards to their economic moat, I think it's their availability and presence. When you go into any Simon Property Group mall or shopping center, they're most likely going to have a Carter's. And besides that point, it doesn't matter if the parents shop at a Target or a Walmart or online at Amazon. If they buy baby clothes, it's most likely going to be a Carter product. And now let's talk about their recent earnings report and latest updates. Well, they just reported their earnings not too long ago, and they beat the top and bottom line expectations, which means they beat on the revenue and in the EPS. However, the bad news is that they suspended guidance for the rest of the year. In other words, it's like plucking the hair off of an Italian guy's back. It irritates and annoys Wall Street, which is why they're going on a sell-off despite a strong quarterly performance. And some other stuff to note is that they improved their balance sheet by going from $268 million of cash on hand to now of $321 million. Not bad. And of course, we got to talk about tariffs, the big dinosaur in the room. As of right now, about 4% of their manufacturing is done in China, with 75% of their clothes being made in Vietnam, India, Cambodia, and Bangladesh. Which means if more tariffs are announced for China this upcoming week, then Carter's should relatively be okay. But they're not exactly going to be in the clear because those tariffs are also increasing for the 4 countries that we just talked about. And that's why the leadership team is kind of fearful of the future. You guys like the fresh haircut? My wife cut it. Anyways, now it's time to break down and analyze their numbers, data, metrics, fundamentals, all of that jazz. The first one is going to be the market cap. And as of right now, it is currently $1.1 billion. So it's not exactly the biggest company in the stock market, but it is still a $1 billion valuation company. It's still big, in my opinion. And what's really interesting is their trailing 12 months revenue, this is what we investors refer to as the top line, is $2.81 billion. Now, as a friendly reminder, the market cap is $1.1 billion. Their revenue, how much cash they're generating, is $2.8 billion. That is pretty bonkers. But here's where it gets a little sad, because year over year, it's a decrease of 3.39%. That's not what you want to see, but I think a lot of companies right now are slowing down and are slowly suffering due to the conditions of the economy, tariffs, and all the uncertainty that's going on. However, what I do want to call out is back in 2020, The revenue picture was $3 billion. So you're telling me in the span of 5 years, they're basically relatively flat. Well, actually, in the grand scheme of things, they're slowly shrinking. So that's what I meant earlier in the arguments against. This company is pretty much stagnant. They're not growing. As a matter of fact, they're kind of shrinking. And so that spits out the price to sales ratio of a 0.39. That is really bad. That means Wall Street is already pricing in weak growth for Carter's. Now, an optimistic person would go ahead and say, hey, this means they're undervalued. But for me, seeing how as it's less than 1 and their guidance for the future is just up in the air, I think they're a 0.39 because Wall Street just does not believe in them. And their forward trading multiple, the price to earnings, so that's going to be a 10.7. which is pretty low, especially in comparison to the other companies in the S&P 500 and in the general stock market. Historically, for the past 20 years on average, it's usually around a 13.7. So their valuation is never too crazy. However, historically, we can go ahead and conclude that as of right now, they are undervalued. And when we take into consideration their EPS, the net income, this is what we investors refer to as the bottom line. This is important because the EPS basically tells us if the company is improving its net income per share or not, their bottom line per share or not. So profitability, very important. And as of right now, for the past trailing 12 months, that is going to be $4.51. Surprisingly, not bad. However, this is where it gets bad because year over year, that's a decrease of, 28.8%. That means their net income went down by 28% year over year. Friends and family, that's not good. Like this entire left column so far, disappointing. However, let's go ahead and see if their debt situation is manageable or not. As of right now, Carter's has about $1.12 billion of total debt. The revenue is $2.8 billion, so not too bad when you put it into perspective. And their EBITDA right now is going to be $312.97 million, which means their debt to EBITDA ratio is going to be a 2.04. So all else being equal, even if they have stagnant growth, if their EBITDA just remains the same, then it would take this company 2 years to pay off all of their loans and all of the debt that is on the books. Now, the operating margin is pretty important because it tells us how much profit is this company generating from its operations. And as of right now, it is a 9.13%. And it's a decrease year over year of negative 9.06%. So not good. The next thing we're going to be looking at is the return on invested capital. We want to know how good is their CapEx spending? How much profit do they make for every dollar of capital that's invested into the business operations? Okay. And as of right now, that's going to be an 8.25%, and that's a decrease year over year of 9.6%. So almost every single metric in financial and fundamental decreasing year over year. This is not good. And the next thing that we want to assess as a potential investment, we want to know, are they buying back the shares or are they diluting the shareholders? We have another positive. Yes. This company is actually aggressively buying back the shares because back in 2010, they had about 59 million shares outstanding. That's it. Only 59 million. That's a really small float in my opinion. And as of today, there is now 36 million shares outstanding. And on that note, it's kind of surprising as to why Warren Buffett is not buying up shares of this company. Because if he's willing to buy into SiriusXM, a company that's also stagnant and actually shrinking year over year, but has a really good balance sheet, why not buy into Carter's? I don't know. Something that is perplexing is that within the company, the executive leadership team and anyone else as a senior leader within Carter's, nobody is buying or selling any shares right now. The last time there was a transaction was a little over a year ago. The next thing that we're going to be taking a look at is the 200-day moving average. It basically tells us whether or not the company has a bullish sentiment behind them. And I mean, obviously, right? If the price is above the 200-day moving average, then the price is going up because investors are buying into it. And if it's below, well, that means the stock is in a downtrend or under pressure. Their 200-day moving average is $52.14, which is below the 200-day moving average by, this is a crazy number. Are you ready? 39.79%. And simplicity's sake, so let's just say 39.8%. That means as of right now, in the filming of this video, they are in a downward trend, and who knows when the bottom is going to be. The next metric we're going to be taking a look at is also a technical analysis indicator, and it's the relative strength index, the RSI. If it's above 70, then we know that it's overbought. Too many people are just pumping into this stock, and eventually people might start selling. This is all speculation. If it's below 30, then it kind of hints at the fact that it might be undervalued because it's oversold. And if it's in that oversold territory, history tells us, sometimes, not always, sometimes that people will start buying because right now it's too cheap for what they are in their valuation. And for Carter's, their RSI is a 29.4. So because they're under 30, it may hint that they're undervalued and oversold. These two right here, don't read too much into it. Technical analysis indicators are all speculative, but both of them tell us that it's going in a downward trend and that it may be undervalued. And the next thing that I like to look at is their performance. And there's many ways to measure it. I like to look at the compound annual growth rate when you break down their performance in an annualized manner. That way you can compare it to another stock that you're looking at or a stock that's already in your portfolio to see, do they deserve to be a part of your portfolio to pay you rent every 3 or 4 or 6 months or whatever their dividend distribution schedule is. And for Carter's, guys, this is, I'm embarrassed for them. It's like sitting next to me in a sauna and we both decide to pull down our pants and we measure each other's peepees and wow, I'm very embarrassed for this company because their performance, check this out. Past 20 years, on average, 2.88%. So just simplicity's sake, we'll say 2.9%. Dude, that's really embarrassing. When you take into account the dividends paid out plus the share price appreciation, to get 2.9% ROI per year, 20 years, no good. In comparison, the benchmark and the standard that we all try to beat is the S&P 500. In the exact same time period, 10.26%. I'm at a loss for words. This is pretty bad. This might be one of the worst comparisons we have seen on this channel. A 2.9% to that of 10.2%. Anyways, before we dismiss them and write them off, let's not be premature, right? Let's look at their dividend profile. I mean, after all, this channel's name is Dividend Compounders with Cheese. So, for every share of Carter's that you own, as of right now, you get paid $1 annually in dividends, which means the dividend yield is 3.19%. We'll just say 3.2%. And the payout ratio, is the dividend sustainable? It is a 22.2%, which means yes, it is sustainable. But what we really want to know as dividend growth investors is this payout of $1 growing or not? Okay? And for Carter's, unfortunately, they did cut the dividend by negative 68.8%. Guys, that's a heavy blow. That's, oh my goodness gracious. And the crazy thing is, after looking at their dividend history, let me just move this right here to clean it up, make it look a little pretty. Well, that just looks worse. But anyways, negative 68.8%. Looking at their dividend history, I found out during the pandemic, this is one of those companies that was highly stressed. They were facing a lot of pressure and they decided to prematurely, as we talked about earlier, to cut their dividend. They did that in 2020. So it's in their DNA to cut the dividend. And I always say that you want to look for whether or not a company does that in their history, because if they do it once, in the next 3, 5, or 10 years, they're more than likely to do it again. They repeat history. And in the case of Carter's, 5 years later, they did decide to cut the dividend again. Although in 2020, they got rid of it altogether. But in our case, it went down by negative 68%. Guys, that's not good. Next thing that we're going to be looking at is the free cash flow per share, because the real ones know that it's cash flow coming into the business that finances and pays for the dividends. So even though this number right here says, hey, it's sustainable, that's an accounting perspective. All that to say, their free cash flow per share is $6.25. And once again, just like almost every other metric here, that's a decrease of 8.5% year over year. This is so disappointing. It's like my Asian child that's non-existent right now coming home and showing me a B+. I'd be like, dude, that's not good enough. My goodness, that is disappointing. That's a joke, by the way. Anyways, the free cash flow payout ratio is going to be 16%. So I guess if we want to talk positive here, I guess the dividend is sustainable for now. Now that the payout ratio is a 16% and the dividend yield is like a 3.2%, prior to them cutting the dividend, I think the dividend yield was somewhere around like 9%. And that's why they caught my attention. But sometime last week, they decided to cut the dividend. And I'm like, oh my goodness gracious. Why? Because, dude, a 9% qualified dividend payment and their payout ratio was like a 55 or 56%. I was like, dude, on surface level, I was like, I want to inspect this company further. But upon doing my research and homework, I'm just like, dude, what is going on here? Which takes me to the next slide. How much is Carter's stock worth? But before we get to that point, I think we need to discuss what has been their past 1 year trading range, meaning their highest price and the lowest price. For Carter's, the highest price past 365 days was $71.99. We can just go ahead and say $72. Currently, right now, they're about $31. Depending on when you watch this, I wouldn't be surprised if they drop down to like $30.50, or dare I say even like $29. But anyways, the lowest price that they hit was just this past trading day of Friday, $31.07. So the reason why I say this is because as we calculate their intrinsic valuation, we want to know, is it too wonky? Is it too crazy? Is it out of the realm of the possibility of their stock market trading pattern? Based on the discounted cash flow analysis model, their free cash flow, and the growth rate thereof, dude, I baked in a 0.01% growth rate for their free cash flow going forward. Because based on my interpretation, their free cash flow is all over the place. Sometimes it goes up by double digits, percentage change year over year, and sometimes it goes down into the negative by like triple digits. Very unpredictable, unstable. So for me, I was just like, you know what? We're just going to go ahead and predict that their free cash flow is going to be relatively flat. So a 0.01% growth rate. And even if we predict that their free cash flow is going to be flat, the DCF valuation model spits out an intrinsic valuation price of $81.22. And I think the reason being is that their balance sheet is actually rock solid and there's only 36 million shares outstanding. If they had more shares outstanding, I think that number would have been lower to like $45 or even like $36. But because there's so little shares outstanding available in the stock market for trading, but also their balance sheet is really good, it doesn't matter if their free cash flow is non-existent growth, it's still going to spit out a really high inherent valuation. So for me, I feel like that's kind of like an outlier number. Do I think Carter's is worth $81? I don't think so. And to put my opinion to the test, we're going to benchmark it to another valuation model. We're going to use the Benjamin Graham's valuation. And in that model and calculation, we're basically baking in that Carter's, the company, will grow at a rate of 1% year over year. Okay? And with that said, then the intrinsic valuation is $32.48 a share, which to me makes a lot more sense. And I think that's more plausible than $81. If we average out the two, Then we get an intrinsic valuation price of $56 a share. I'm going to be honest with you, this is not financial advice, but this number right here just sounds a little too optimistic and rosy for my taste. So we're just going to go with $32 is what we said. The Wall Street analysts believe that Carter should be valued at $36.80 per share, which is an upside of 17% from their current trading price. So we're saying 32, Wall Street is saying 36. Regardless of who's right, I guess right now Carter's is undervalued, but can't wholeheartedly say that it's a very high quality company that is on the discount. So it's just undervalued, all right? So taking that all into consideration, let's just go ahead and say that someone is still interested in Carter's after learning about their company's story, their future prospects, and their numbers, and you're trying to figure out what's a good value investing price to buy into Carter's. This is not financial advice, but a good price would be $30 per share, which I don't know. I can't tell the future, but I think in the upcoming week or two, I think Carter's might hit $30 a share. All right. And a bargain price to buy into Carter's, I don't even know if it's a bargain at 27 because it's so low quality. But a bargain price would be $27 a share. And a steal, is it really a steal? But a steal price would be $25 per share. Which brings us to the final verdict. Is Carter's a dividend compounder with cheese? And before we declare whether or not it is, we got to figure out what's their grade. I think, based on the short term, is it fair for me to say that this is a D plus type of business? They're slightly below average. So in the next 6 to 24 months, D plus. But what about the long run? The next 10 to 20, 30 years? Do I see babies going away anytime soon? No. Do I see their market share disappearing? No. So I think in the long run, if they are able to recover, as evidenced by their stock price in the stock market whenever they go through a good period, they unjustifiably go way up in valuation, right? It's not weird to see them go up to $90 a share. So I think in the long run, they're a C plus. And one person might even argue like, dude, so wouldn't it be a good time to buy into them right now while they're facing some headwinds? Because in the next 5 to 10 years, they're definitely going to bounce back to 60 or $70. I mean, to that I say, dude, past performance is not indicative of future gains, especially a baby clothes manufacturer. But on the other side of that perspective, they could also go belly up and go bankrupt like Enron. So who's to tell, right? Is it going to surprise you that, in my opinion, I don't think Carter's is a dividend compounder? I mean, I wouldn't go as far as to say that they're disgusting. They're not this purple block right here, because then the grade should be like an F. But to be honest with one another, heart to heart, nipple to nipple, I don't think they're decent either. I think they're somewhere in between. Okay, so I think the label that we're going to give them is dirty. I think if they get a car wash and get the tires all polished and shined, I think they could be a C plus in the long run, but who's to tell, right? I can't tell the future. And before I tell you my personal game plan when it comes to Carter's, I mean, I did spend 10 hours researching this company. Here, before I reveal, take a look at their performance, right? We already talked about it, but in the past 20 years, their adjusted stock price total return, this takes into account the dividends that were paid out, 76%. Guys, there's just no way to spin it, lie, manipulate. Dude, that's just not good enough. In 20 years, a 76% total return, dude, that's not good. However, to be fair, I feel like up until very recently, they were doing pretty well, just like Nike. Right? They were crushing it, I would argue. Because if we redo the calculation, their total return, and only go up to April of 2021, then it would have been 345%. And my opinion would be, yes, this is absolutely a dividend compounder. If they 3x your money in 20 years, that's a compounder. However, the truth is, in the past 3.5 years, their stock price essentially went from $110 a share to what it is today of about $30 a share. That's really freaking bad. Now, I genuinely feel for you. If you bought into Carter's back in 2020 or 2021 when they were trading for about $110 a share, dude, I feel sorry for you. That sucks. I've been there. I know what it feels like. It's not a good feeling. But I think that's why it's so important when you are evaluating and eyeballing a potential investment. Don't just look at their numbers and financials. Also take a look at how do they perform in the stock market. All that to say, what is my game plan with Carter's? My thoughts and opinions after looking at everything. My personal opinion is that what's in fashion and in style today will not be tomorrow, because there's always another up-and-coming brand to take your spot, or your competitor is now the trendy and the cool thing to wear. And that's why ultimately I avoid clothing brand stocks like Nike, Under Armour, Gap. The competition is just way too ruthless. Unless you're in a very specialty niche and you're like the best in class, you have a huge economic moat and your financials look really good, then I would entertain you being a part of the family. But with Carter's, I mean, I get it, right? It's a specific niche and the customer is a baby, but what I'm trying to say is, what is their catalyst? Like, what's their future growth story? Who is to say that they're not going to continue to shrink year over year until 2030 and then shrink some more until 2040, right? I mean, obviously that might not happen, but their data and their trend tells us that's what's happening right now, at least for the last 3.5 years. And so if I want a 3% dividend yield with at least a 10% CAGR, I feel like there are better options out here in the stock market. I mean, it's not financial advice. Me personally, in the past 4 weeks, I've been doubling down on the food stocks like Conagra Brands, General Mills, Flowers Foods, and PepsiCo. I might be wrong, but I think once they do rebound and recover, they should outperform the S&P 500, at least in the next 5 years. I could be wrong. I'm going to say that again. I could be wrong, but that's what I believe. And their dividend yields are almost all above 4 or 5%, and their financials look good. Obviously, I think every single one of those companies that I'm investing into, their growth story, their revenue is stalling right now, but I think that's a temporary issue. And with due time, I think they'll be crushing it once again, like they have been for the past 70, 80, or almost 100 years. Food is a consumer staple. It's what we need to sustain life. We're always going to be eating it. And as the global human population continues to rise and grow, food is going to be needed in a bigger capacity. So, I don't know. My investment thesis, I think it's sound. However, if I'm wrong, I'll give you guys an update 3 to 5 years. Like, I regret buying the food stocks, but I don't think we'll be making that video. I hope not. And before I close out this video, I wanted to do another word for thought. Just talk to you, amigo to amigo, friend to friend. So, for the longest time, I mean, I talk about it a lot, okay? Mental health is super important to me. For the longest time, I was depressed, okay, for almost a decade. And during that duration, obviously there were times when I was laughing and I felt happy, but that was only like a glimpse, okay? Like 99.9% of the time, I was negative, cynical, I was a grouch, and I don't think I was a very pleasant person to be around. With that type of perspective and thinking, dude, of course not, right? But the thing is, I wasn't always like that, because in my teenage years, and especially in my youth, I was always a half full, optimistic, that super positive kind of guy. I think all of my friends growing up, they associated me with the guy that just always smiles. And that's something I'm just trying to bring back, okay? Hear me out. Don't click out. Just hear me out, okay? Because regardless if you're an introvert, ugly, or if you're weird, we've all been around people in this world that are just different. What do I mean by that? They've got the sun living inside of them. No, they're not fat. No, they're not smelly, but a sun within them. No matter the situation or conversation, they've always got good vibes and good energy surrounding them. You know what I'm talking about? We all know at least one person like that. They walk into a room and everybody is like, it's him or it's her. They bring the best out of people, they light up the room, and they just make your day better by interacting with them. And I feel like when I was a manager in corporate America, I feel like that's the kind of person my team members would define me and describe me as. But personally, I feel like, man, I was so miserable. But anyways, the wild thing is these people that bring out the best in other people, what you have to know is that they usually have walked through fire. They have been through and endured through unimaginable pain, okay? And rather than just letting that pain make them all poopy pants and all grouchy like it did with me, instead it gave them a new perspective on life. Actually, after thinking about it, almost every single roommate that I've ever had, they were one of these people. So on a personal level, I can tell you they're some of the best people to be around. And I feel lucky that I always had a roommate that was like that. I can tell you that every single one of them, they went through some kind of like trauma or hardship, but somehow it just made them a more kind and gentle human being. I would argue I'm a student of life. I've learned that I'm not the smartest person in the room. Everyone has the ability to teach me something if I'm willing to humble myself and say, you know more than me. But anyways, I'm always learning, and what I've learned is that these positive folks, dude, they don't just become that way by accident, right? You don't just wake up one day and say, oh, I'm going to be so nice. Even though I grew up in poverty and I was faced with racism and whatnot, I'm going to be a nice person. They don't just magically come to that conclusion. The thing is, somewhere along the line, whether they were a teenager or as a young adult, they made a deliberate choice, a decision not to let the worst moments of their life to define them. And honestly, I think reflecting and thinking about myself, one of the reasons why I was so hopeless and depressed is because I did the exact opposite. I let my past shape how I showed up in this world, especially to myself. And what's worse is I was super cruel with my choice of words, especially what I said to myself whenever I made a mistake. Like, I'm telling you right now, if someone were to say that to me, the stuff that I said to myself, we would have to fight. I would have to take off all my clothes, get butt naked, and be like, say it again. But I was saying that to myself day in and day out. However, not too long ago, I've been doing things differently. And even my wife has noticed. She's like, man, this is crazy. You feel like a new person again. And that's because one day I just woke up and decided I had to make the conscious decision and choice to be someone who brings light. Because I was sick and tired of being that negative Nancy, just being that grouchy Gary. I just didn't want to be that anymore. I mean, obviously there were days where I, defaulted back to my usual self, but telling myself every morning that I'm going to be positive, I'm going to be optimistic, and choosing to be that person day in and day out, eventually it just became a habit, and now I'm back to my old self. And I think that's pretty crazy. And obviously, this mental framework is only one aspect as to why I overcame depression. And I think other reasons are also just as valuable, such as like physical fitness, cleaning up my diet, cleaning up my sleep schedule and everything. But anyways, I'm back. And I'm back not because life's perfect. I mean, for crying out loud, I work a minimum wage job. But on the flip side, I also get to do YouTube full time. I'm running 3 different YouTube channels. But anyways, it's because I finally chose not to let the darkness have the final word. And life's been much, much better with this way of thinking and framework. And that's why when I first launched this channel, I didn't even show my face because I was so ashamed and disappointed with myself that I didn't have the confidence to even show my authentic self to the world. And the fact that I'm able to show my face to the world because I'm doing better now, I'm like, man, that's crazy. And to elaborate on that, man, much of my 20s, from age 22 to 31, I wasted so much time just being upset and depressed. And it's unfortunate that I can't get that time back. But, going forward, I can change how my future will look. And that's why I wanted to just say this, think out loud, because before you dismiss everything that I just said, dude, I'm telling you, positive thinking and encouraging words, I know it sounds cliche like lip service, but they truly work. Okay, so if I can just impact at least one person out there, that's the whole point of it. Anyways, I love you guys. Stay safe. Good luck in the stock market. And tell me what your plans are with Carter's. What do you think? Do you think it's juicy? Do you think it's ugly? Do you agree or disagree? Let me know. And I'll talk to you guys next time. Peace.